Hello, class, and welcome to our eighth lecture series on managerial accounting. And I'm your instructor, Jamal Haithar. Okay, so our midterm exam is going to be on 12th of May. So, till the variable costing that we will finish today, so up till today, we would be including all those material in our midterm exam. Okay, so at the end of this lecture, we will talk about the paper pattern and all the stuff. So, I think all of you guys already have one or two subjects from me, so you already know that what kind of paper and how I conduct the paper. It's going to be part one, part two, part one MCQs, and this kind of stuff, right? So you already have the idea, but we'll talk about at the end of this lecture the construction of our midterm exam. Okay, did you note that our midterm exam is on 12th of May, right? And so the material going to be covered in midterm, including today's lecture. Okay. Okay.
Excuse me.
Yes.
Do you know which hour it will be? Like usual?
Yeah, like last time.
Okay.
Okay. So if you already know about, or if you don't have any question regarding our previous lecture, CVP analysis, so please find out the answer of this question. So all of you guys, I'm going to give you 5 minutes to do that. Everyone, please. And I'm going to pick, I think, I'm going to pick Sunho to answer this question. Sunho.
Yes, sir.
What is the answer? Okay, Minsu? Tumei? William? Hello?
I haven't got the answer.
What is the answer here? So let me write the formula here.
1,000 units.
Here we go. Target profit is equal to, units is equal to target profit plus fixed expenses divided by CM in units. That's it. Right? So don't confuse yourself with equation formula or formula. Just write. I told you in our last class, remember one formula and you can rearrange the formula. Okay, now this is pretty serious. Now answer this question, everyone. Amila, please do that. Camila, can you hear us?
Yes, sir. I'm trying to work on it.
Ayana, also do that.
Okay. Yeah, I'm doing it.
So what we need to do here in requirement 1, first we need to find out break-even dollar sales, and we'll less it from the actual sales. We find out the margin of safety, and then margin of safety in percentage, the margin of safety divided by sales. Simple. So you have 5 minutes to do that. Camila, Ayana. Minsu, you understand what's going on?
Yeah.
Okay, Sunho.
Yeah.
Okay, please do that. Let me know the answer. What is the answer of part 1?
Is it 22,500?
Did you calculate, Ayana?
Not yet, sir.
Okay. What is the formula for break even in dollars?
Fixed cost, fixed cost divided by contribution margin.
Which contribution margin, ratio or unit?
Units.
You can also do that. And you can also do that with dollar sale as well. So here we go. Let me give you the answer. So break-even units are 750, right? The formula is break-even in units, fixed cost divided by CM in units, right? Fixed cost. How much we have the fixed cost here? 7,500. So 7,500. What is CM? Sale price per unit, 30, variable cost, 20, right? So answer would be 10, 750 units, right? So sales right now is 1,000. You see here? 1,000. So how much is the margin of safety? 1,000 minus 250. We are 250 units above. Or if you multiply it with the selling price 30, you would find out dollar margin of safety.
77, right?
No. 7,500. Right? 250 multiplied by 30. What is the answer here? Right, 7,500. So margin of safety in dollars it is $7,500. In units, 250 units, right? See, in dollars. And we want to find out margin of safety ratio. So you can also do that. Margin of safety divided by 250 units divided by sales, 1,000. Or if you want to do that with terms of dollars, so margin of safety in dollars divided by sales in dollars. Sales, 30,000. 1,000 are the units. Multiply by 30 is the price. Answer will leave you 25%, both. Ayana, Camila, Sunho, Minsu, right? Understand?
Yes, sir.
Yeah.
Good.
Yes, sir.
Leo, did your answer match here?
I had something mixed up, but I got it now.
Okay, don't worry. Okay, this is a little bit lengthy question, but just pause the video here and try to read the question and then solve it. But remember, guys, the question I put here, these are really important questions. So I've also put the answers here. You can also, in your free time, or you can have your Zoom or Chumo meeting with your colleagues and friends. You can do this example as well. Okay, this is another question, the complete question. Although also some decision making involved. I have pasted solution here. This one is also the question. Okay, the simple one, you have to find out break-even point. So I have also pasted the solution. Okay, so the solution is missing here. Okay, I would be pasting solution here as well. So to be on the same page, so if you have any question regarding our CVP analysis, which is very important chapter, also for your practical life as well. So please do ask question or post the question in our WeChat discussion forum and our Blackboard discussion forum as well. Okay, today we are starting a new chapter which would be also included in our midterm exam. We call this variable costing, which is a new perspective of costing, and we have its different applications as well. So let's talk about this. Most of this costing you already know because we just completed our contribution margin, so it's related to contribution margin as well. Okay, so explain number one learning objective, that is explain how variable costing differs from absorption costing and compute the unit product cost under each method. Let's talk about this. First, we segregate what is variable costing and what is our traditional costing or absorption costing. So, absorption costing, we also call this full cost method. In this, we include both variable and fixed cost to calculate the unit cost, right? So it means absorption costing treats all the cost as product cost, regardless of whether their nature, whether they have a variable nature, whether they have fixed nature, right? So whether the cost behave like a variable, whether the cost behave like a fixed, so everything is included in absorption costing, just like average method, right? You take all the cost and you divide it by the numbers, you find out absorption costing. So since no distinction is made between variable and fixed cost, absorption costing is not well suited for CVP computation. You know what